Good morning, everyone. Good morning, Gonkar, Santosh, Amol.
Good morning, sir.
Can you all hear me?
Morning, sir.
Yes, sir.
Okay, should we begin for today? Okay, so what we'll do
Yes,
is we will begin with a quick recap of what we did yesterday. Okay. If somebody was to ask you, okay, and just raise your hands and please answer the question. Yeah. Sure, karte. Let's do it. Okay, so if somebody was to ask you, what is the difference between a commercial bank and an investment bank? What would you say? Okay, go on. Tell me.
Commercial bank give loans and people deposits their money and investment bank helps to raise capital, helps with the mergers and acquisition and advisory services and also AMC.
Asset management service. Right? So their services do not match anywhere. It's not as if they are competitors with each other because their services are completely different in nature. Okay. If somebody was to ask you, what is the difference between capital market and money market? What would be your answer? Yes.
Capital market, if you want to start a business, you will go in capital market. It is a long term. It is for long term. And money market is for short term, in which you will go for day-to-day work.
Absolutely.
Or you want to buy some raw material or likely expand your business.
Expand your business will be capital. Okay. Capital market is not just about starting the business. Okay. Even significant expansion of business will come through capital markets, right? For example, right now, let us say there is an Indian company who plans to go abroad and become a multinational, set up plants, maybe in Vietnam, maybe in Philippines, maybe in UAE. Okay, they will need a lot of capital for it, right? So if you need money for a long term, it is capital market. If you need money for short term, we call it money markets. Okay. For raising money for long term, for capital markets, there are two ways to do so. Which are those?
Equity and
Equity and debt. Equity and debt. Okay. Now, what kind of debt is this? This is long-term debt. And as far as equity is concerned, there is no repayment concept in equity. Equity is forever, right? You can sell the equity if you want, whenever you want, wherever you want it. But as such, the equity is forever. Right? Are you with me on this? Okay. If you want to raise money to buy, you have got a huge order, okay, 10 crore worth of order, but the things that you need for that order, the money, you don't have money to buy them. What market will you go to? Capital market or money market? Money market. Why money market?
Money market.
Yeah. After some time, we will repay it. We don't need this money for a long time. We need this money only for a short time. Why would you not go to equity markets for short-term periods? Yes, anyone? Online? Omkar? Santosh? What's the point? Tell me. The whole point is that debt market becomes a risky proposition in long term for a entrepreneur, right? Because after all, there is always a chance that things will not go as planned. Okay, think about the situation now. Okay, last year or maybe a few months back, if somebody in Ukraine would have identified a very smart business idea, okay, and the idea was perfect in all respects, and the business should ideally have been making lots of profits, okay, but somebody sitting in the neighboring country, Putin had completely different plans, okay, and now this person who might have started this business is probably reeling under debt and is thinking, how am I going to repay the interest and from where will I repay the loan? Right? Okay, but in short term, those are not the concerns. In short term, those are not the concerns. Equity is forever. Why would you raise a forever set of capital for a very short duration? Okay, so the amount of money that you take for the period should match with the amount you need, right? If you need money for 3 months, why would you raise an amount forever, in perpetuity, right? You are going to give back the money after 3 years, 3 months, or 6 months, or 1 year, right? So while in capital markets you have debt and equity, in money market you have debt only. You don't raise equity for your day-to-day operations. Okay. So that's the capital market and money market. Okay. Now in capital market, we have already looked at there are two different markets, debt market and equity markets. Okay. What do you mean by debt market? Yes.
Debt market is a market where you borrow money from investors, where you have to repay the loan as well as the interest rate.
So debt market is a market where just like equities, debt instruments are issued. Why would a issuer issue these instruments? An issuer would issue these instruments because they believe that they can, instead of taking loan from the bank, they can take a loan directly from whom? Directly from investors. Why would they do so? Because after all, bank does not give their own money. They are an intermediary, which means they have a cost of funds. And hence they need to make profit on those cost of funds. The profit that they make, the difference between the cost of funds and the rate at which they lend funds is called as net interest margin. So they have to have a net interest margin, NIM. Okay. Uh, on the contrary, if I were to directly go to investors, they can get a better return than banks. Okay. Who is the biggest issuer of debt in India? Or for that matter, in most countries? Hmm? So if you look at the debt market, there are two kinds of debt. One is government issued debt and one is company or corporate debt. Okay. So the biggest taker of loans in the country is government of India. Okay. So within the debt market, you can have debt taken by government, loan taken by government, and loan taken by corporates. Okay. If government needs loan, it doesn't need to go to the bank, because in case if banks are in trouble, people will expect the government to save them. Okay. So if government needs loan, it won't go to the bank. It would directly raise money by issuing bonds. So government might come out with bonds saying that, okay, we are coming out with this 1,000 rupee bond and we will pay a coupon of 5% every year to whosoever buy this bonds. So government will get 1,000 rupees, and let us say if this bond is for 15 years, for next 15 years, they will keep paying out 5 rupees of coupon. Right? So that is how a government bond works, or government security works. A question that is often asked is, why does the government need to raise loans? After all, they have the printing press, they can print money if they need more money. Mhm.
To balance.
Liquidity will be better maintained by printing notes. More notes, more liquidity, right? Okay. In fact, they will suck up the liquidity, because if they are raising, if they are asking, no, government does not ask for lakh, 2 lakh, or 100, 200 crore. They have, their loans are in, for example, the recent tranche of loans was something around 23,000 crores. So that 23,000 crores, which several financial institutions or banks or individuals, high net worth individuals, they could have invested elsewhere, is now gone to the government. So as such, that much liquidity is out of the market. Okay. So every time government borrows, liquidity will not go up, it will go down. Inflation is clearly the right answer. See, what happens is, if you print note after note after note, okay, everybody has more money. Okay, think about this in a very, very simple way. Imagine if this bottle has to be sold, a bottle of water has to be sold. Okay, and the seller is quoting 20 rupees for this bottle of water. Okay, but now suddenly people have more money in their pockets. Okay, so everybody wants to buy more stuff. Okay, but does more stuff appear magically in the shops, more stuff and services? No. So the number of goods are same. Okay, so what happens? More money is chasing the same stuff, so not everybody will be able to buy. Okay, which means what we have done is increased the demand, but the supply is just there. Okay, supply is just there. What will it result into? It will result into a situation where, because of the increased demand, prices will increase, thereby negating any impact of printing the notes. Okay, so you might say that last month I earned 10,000 rupees, this month I earned 15,000 rupees, but whatever I could buy in 10,000 rupees last month is also what I'm buying in 15,000 rupees this month. Okay, is this just theory, or do we actually have practical examples of this in the world? Do we know of any countries that have printed note after note after note with the expectation of getting out of poverty? I don't know about Vietnam.
Sir, I think Venezuela.
Sorry,
Venezuela.
Venezuela is one example. Okay, now these stories are very fascinating, and we might discuss a little more on this as well. One live example right now is Turkey. Okay, Turkey is facing super high inflation because of ignoring basic economics. Okay, And if you say a worst ever inflation factored in by any country, I think probably the crown would go to Zimbabwe. Okay. There was a time in Zimbabwe where you could fill up this entire room with notes. Okay. And there is this door sign which says, please don't close the door because the door is jammed. The door doesn't close. And nobody will have to worry about the fact that ये बंद दरवाजा बंद नहीं होता, हम खुले दरवाजे के अंदर पूरा रूम नोट से भर के ला रहे, कोई कुछ नहीं ले जाए, because the notes are so worthless. Okay, you could take people filling up a bucket of notes and another bucket of notes and walking to the market to buy bananas. Okay, that was the amount of valuelessness of notes. Okay, in Zimbabwe. Okay, so they went on to print bigger and bigger and bigger and bigger notes. Okay, so Zimbabwe went on to put their currency is also called dollar. So they went on to print 1,000 Zimbabwe dollars, 10,000 Zimbabwe dollars notes, million Zimbabwe dollar notes. How much is 1 million, by the way? 10 lakhs. So many times people have confusion. 1 million is 10 lakhs. Okay. And probably Zimbabwe is the only country which also issued a $1 billion. Okay. And even that was worthless. So printing money haphazardly could bring us to these kind of situations. So ideally, a sensible government or a country, if they are short of funds, should take debt. And most countries will need debt sooner or later, except for oil-rich countries, okay, who run surplus budgets. Otherwise, most countries run deficit budgets. Okay, so the countries will need debt. Okay, so within the debt market, we can subdivide the debt market into government bonds and corporate bonds. Okay, government bonds are also called as GSEC or government security. Just a second, I'll open back the Excel sheet and we'll keep writing all of this in our notes there. Come in. Is there a chair? So debts are of two types: government securities, government bonds. So debt, you have government bonds and you have corporate debt. Now, government bonds are also called as government security, GSEC, and they are also called as gilt-edged securities. I mean, GSEC could stand for government securities or could also stand for gilt-edged securities. Okay, now for most purposes these days they are called government securities or GSEC, but in case somebody uses the word gilt-edged securities, you should be aware what they mean. Okay, it's not some kind of new term. It's not, so it's a different term, but it's not a new instrument that you don't know about. It's just the government security that they're referring. Okay, there is also a reason why it used to be called gilt-edged securities once upon a time. Because in good old days, when things were not dematerialized, when actually you would get certificates, okay, you would get it printed on a nice paper with a golden border. So that was called as gilt edge. Okay, and that is why these would be called as gilt edged securities. Okay, and then you have corporate debt. These are also called as debentures. Then talking about equity markets. In equity markets, okay, first and foremost, even in debt market, we can have something called as primary market and secondary market. Even in primary market, we can have, even in debt, we can have a primary market and secondary market. What do you mean by primary market? The market where new issues come in is called as the primary market. And the market where the already existing issues get traded are called as secondary market. Does debt get traded? Can you buy or sell the bonds after they are issued? Yes or no? See, one of the biggest problems might happen with a bond is, let us say you put a 10 lakh rupees FD in a bank for a period of 3 years. Okay. But suddenly you need the money. So you are anticipating that you will not need this money for 3 years. So you are going and making a bank fixed deposit for 3 years. But suddenly if you need the money and you need to withdraw, what will you do? Option 1, will you be able to go to the bank and break the FD and lose some interest, but at least get the money back? Or
Yes.
will you go to your, will you find a buyer for the FD and be able to sell the FD to somebody else and take money from them? Which of the two is possible to do? The first one. Is the second one possible to do? No. FD, bank FDs are not tradable, and hence there is nothing called as FD market. Right? Have you heard of an FD market? No. Because you cannot buy an FD, you cannot sell an FD. So where is the question of a market for FDs? Okay. If you want your money back, you have to go to the same bank and ask them for money back. Or probably you don't just have to go to their website. You don't even have to go to the bank. Okay. So all you need to do is go to the bank's website, cancel the FD, get the money transferred to your savings account or current account. As simple as that. Okay. Now, why can a bank do it? Bank can do it because it's a marketplace of money. Every single day, millions of FDs will expire. Millions of people will withdraw funds. But then there are another millions will deposit funds and another millions will make FDs. Right? So bank is the marketplace for money. That is why bank can take care of all this. Okay. But think now from the perspective of a person who has a project to fulfill. Okay. I have a great project to fulfill. I have won a highway contract from the government. Okay. So I'm about to make highways. Okay. And government has asked me to make the highway and then take toll from the toll booth. That is how I'm going to make money after I make the highway. Okay. So now the highway making in this the progress, the tolls have not even been set up yet. Okay. And somebody comes and asks me, I want my money back. Can this issuer give the money back? No. Where will the issuer give the money back? Right. So if for the purposes of bond, this will become a major obstacle, right? I am happy giving you money for 5 years, but I need to know that if I need money somewhere in between, will I be able to get it? So the issuer of debt tells me, yeah, what we will do is we will get this debt listed. You can sell this debt to anybody else, right? You can't sell your FDs. FDs are non-tradable, non-negotiable. Bonds or corporate bonds, debentures, government securities, they are all tradable, sellable. Okay. Because the issuer of those bonds or debentures cannot promise that, okay, if you come to me, I'll have money. That's not what they're promising. They'll say, I need a money to build a highway today. Only after the highway is built and I set up my tolls and I started collecting tolls, I will slowly get money, enough money to one fine day pay you off your bonds. That's my plan. Okay. Suddenly, if you come to me and ask me money in between, I don't have. But do one thing, sell off this debt, sell off this debenture to anybody else. I am not concerned about who owns the debenture. Okay. You bought the debenture, you sold the debenture to her. Next time, when I have to pay the coupon, interest payment is called as coupon payment in bonds. I'll pay the coupon to her. Next, I'll pay the coupon to her. So whoever owns the bond on the date of coupon payment, I will pay the coupon to them. Pretty simple. Okay. So fixed deposits, are they sellable? No. So for liquidity, what do you do? Go to the bank and break it. Bonds can I go to the issuer and ask them for the money back whenever I want it? No, they will pay me on the maturity only. So for liquidity, what can I do? Sell it off. Sell it off. Now, currently, debt market is not a very active market in India. Okay. But in some countries, debt market is bigger than the equity market. More trading of debt happens than equity. Example in US. In US, debt market is the bigger market. Debt is traded more than equity. What do I mean by traded? Bought and sold. Okay. Efforts are being made to create an active debt market in India so that if debt, once the investors know that selling off will be easy whenever I want, okay, more and more will start subscribing to things. Okay, going back to the equity market now. Equity is raised only for capital purposes. Okay. From an investor's perspective, what is safer, raising equity or raising debt? Raising equity. Why? Because I'm not promising repayment. I don't have to promise any repayment. And neither do I have to promise any fixed returns. Okay. That is why if you look at people analyzing the companies, they have a preference for debt-free companies. Because in case there are temporary setbacks, they can override them because they don't have to pay anybody interest. Okay. So as a issuer, okay, as an entrepreneur, as a company, okay, equity is far safer because I am first and foremost getting capital for perpetuity with no repayment promised. I am also not promising any sort of returns on that. Okay. I'm telling investors that my company is going to grow 3x, 4x, 5x, and thereby the stock price will go 3x, 4x, 5x. Okay. But am I making any promises? Am I making any guarantees? No. Whereas in debt, I would be making guarantees of repayment of interest as well as repayment of principal. Okay. Obviously, from an investor standpoint, which is riskier? From an investor standpoint. From an investor standpoint, it's equity which is risky. And from an entrepreneur standpoint, it is debt which is risky. Okay. And whenever somebody takes a higher risk, they are entitled to expect a higher return. Just expect, not really get. Whether they get or not, only time will tell. Okay, now we also spoke about the way, the structure in which the trades happen. Just give me a moment. Okay, so when a company comes up with a new IPO, which market do they access? Primary market. And what institution will the company approach in the primary market for in order to bring out their IPO? The investment bank, who will act as the lead manager, who will act as the lead manager or merchant banker. Okay, and they'll be doing an entire process which we will learn about as we go into the details of that topic. Okay, now once the IPO is done, what happens to those shares? Does the company leave you to trade on over the counter markets, or does the company get listed on the stock exchange? Listed on the stock exchange, because trading on over the counter markets is a pretty hard thing to do. It's not an easy thing to do, right? For an exchange trade, all you have to is sit here and click buttons, give an order, and if a matching order is found on the exchange where millions of orders are put, so a matching order finding is not really so difficult as long as you are trading in large stocks, large cap stocks. Okay, so matching order finding will not be so difficult if you restrict yourself to large cap stocks. Okay, so you can find these matching orders. Okay, and what that means is that you can sell anytime. Okay, so if a company tells you that, okay, we want money, we are coming up in the primary market, but we have no plans to list in the secondary market, chances are that people will be hesitating to buy those issues. So they will need to get listed on the secondary market. Once they get listed on the secondary market, how will the buying and selling happen? There is a buyer and there is a seller. Do they go to the exchange themselves and buy and sell? No. Then what do? They go to their respective brokers. They go to their respective brokers. Okay. Now, what do the brokers do? Brokers send the orders to the exchange. Okay. And in the exchange, what happens? Automatic order matching system matches the orders which match with each other. If the orders match with each other, trade happens. What happens if the orders don't match in quantity? Will the trade be rejected by the AOMS? No, why? It will be partially fulfilled. It will be partially fulfilled. And then from the next order, it can be, the rest of it will be fulfilled. So chances are that many of the trades might be actually, if I bought 100 shares, chances are that all 100 might have come from one seller only, but chances are that they might have come from 3-4 different sellers. Okay, I wouldn't even know that. If once again I sold 500 shares, chances are all of them might have been bought by a single person, or they might have been bought by all different people as well. Right? So both of these options, so both of these possibilities are there. Okay. Now, once the order is matched, the shares automatically get transferred into buyer and seller's individual account, buyer's account, and money automatically gets transferred into seller's account. True or false? False. There is a process behind it. There are two different organizations, there are multiple organizations which have to start their work now for every order that gets matched. Okay. So which is the organization which makes sure that all the transactional work is completed to make sure that the shares can be transferred to the buyer and the money can be transferred to the seller? Who is this organization? The clearing house. Okay. Now, clearing house, in order to make sure things are taken properly in the clearing house, what will the broker do? They will have a clearing member who will interact with the clearing house. Okay. Each of the brokers will have their clearing member. Okay, but all the transactions are done, but finally now the ownership needs to pass on, okay, at the place where all the stocks are. Yesterday we saw that ownership of money, the money was there in the banking system first also, and then you transferred the money to somebody else, then also the banking system has the money. But the ownership of that money has been transferred from you to somebody else. Okay. So now in this case, who is the bank for all these shares? Where it is that all the shares are kept? The depository. Just like the money is kept in the bank, the shares are kept at the depository. Okay. But now with a bank, it's simple. I can go to bank and open a bank account. Can I go to a depository and open a depository account? No, I can't do that. I can do that. Only a depository participant can do that. Okay. So I will actually have an account with the depository participant, and depository participant will have a lump sum account with the depository on behalf of all its customers. Okay. So that is how the things work. In order for the system to work, you have brokers, you have exchange, you have clearing house, you have depository, you have clearing members, you have depository participants. Right? Is this clear? Okay. And if you look at the list of participants that you made, what do we have here? Investors, brokers, stock exchange, clearing house, clearing member, DP. Then apart from this, we have regulators, okay, banks, credit rating agencies, asset management companies, investment banks. Okay. And lastly, we talked about order-driven system and code-driven system. Okay, can somebody explain to me what is an order-driven market? If somebody asks you, what do you exactly mean by an order-driven market? What would you say? Yeah.
Order-driven market is the system which is used in India, right? India. It is a market where you place the order and you get the order. You don't have a bid price or ask price.
Mm-hmm. You don't have a bid price and ask price, you have a single price.
Single price.
Okay. So if there is no difference in the buying price and selling price, then how is the broker going to make any money? Is the broker doing social service? Then how will the broker make money? Yeah, if the price matches, buyer will buy, seller will sell. Buyer will get the security, seller will get the money. What will the broker get? Brokerage. So in an order driven market, broker gets the brokerage. We also talked about the example of an order driven market in real life other than financial markets, real estate market.
Yes.
Okay. In real estate market, the property agent does not buy your properties and keep them. Okay. I want to sell a property for 1 crore. So the real estate agent will not buy the property of 1 crore and keep it and then try to sell it to somebody else at 1.2 crores. No. If somebody wants to sell their property for 1 crore, the real estate agent will try and find a appropriate buyer, get their deal done and take commissions. Okay. So the buyer will buy for 1 crore, seller will sell for 1 crore. They'll sell at each price, same price, obviously, and in between they will have to pay commission. So in Indian stock market, system is like that. There is no concept of bid price, ask price. Okay. So both of them will buy and sell at the same price, and both of them will pay commissions to their respective brokers. Okay, which is called as brokerage. Okay. On the other hand, in a quote-driven market, what happens? In the quote-driven market, the example that we took was gold merchant. Okay, jeweler. You go to sell gold, they will buy the gold. They will not try to find you a customer. Acha, you want to sell gold? Let me try and find you a customer who wants to buy gold today. No, they will just take the gold and then they will sell it to somebody else. Okay. So in an order driven market, the intermediary does not, the broker does not hold on to the assets at any point of time. Okay. The intermediary's job is to just match the buyer and the seller. It does not by themselves hold on to the asset at any point of time. Whereas in a quote driven market, the intermediary constantly keeps getting possession of the asset, sends it to somebody else, sends it to somebody else, takes possession, sends it, takes possession. So it's constantly moving state, but the assets keep coming back to the intermediary all the time on their own account. Okay. So what does an intermediary do? They have a bid price and a ask price. Bid price is what they are saying that this is the price that I will buy at. Okay. So a jeweler might say my bid price for 22 karat gold is 48,000. My ask price is 48,100. Okay. That 100 is obviously their profit because they are not charging any brokerage, right? Okay. If I buy also at 48,000 and sell also at 48,000, then how will I make money? I am not charging any brokerage, right? Okay. So if you think of it, quote-driven market is more like a shop. A shop needs to buy at a lesser price from the wholesaler. So let's just say if a shop buys from wholesaler at 100 rupees, that is the bid price. And then they put the stuff in their shop and sell it at 150 rupees, that is the ask price. Okay. So a shop will have goods and services available inside the premises. Okay. They will store the goods. Just like that, a quote-driven market, in a quote-driven market, the intermediary themselves keep buying all the time and selling all the time. Right? Is this point clear? Is this clear to you? Okay. Now, one important thing. Every single day, I would like to ask you to reply back, because you do know that the way we conduct the assessments is through mocks in this, right? You're aware of that, right? Okay. So mock is a one-to-one interview style test. Okay. And every single mock, we are surprised by the students who we expected to do very well, not doing well at all. And every single time the reply is, I understand, but I can't explain. But understanding and not explaining is not good enough. Okay. And with this batch, I would like to make sure that we get it rectified right at the beginning. Okay. Understanding and not explaining will not get you a job. Right? You will not be able to do anything in the interview. Right? You can't tell your interviewer that I understand, but I can't explain. Getting my point here? Okay. So that is why I'll keep asking you again and again, how will you explain this? How will you explain that? And I would expect replies, because this is what will help you. Okay. Okay, so we have order driven market and we have quote driven markets. Okay. Currency markets, are they order driven markets or are they quote driven markets? They are quote driven markets. Across the world, there is nowhere a place where currency market is a order driven market. It's a quote driven market everywhere. The dealers, the banks, anybody trading in currency has a bid price and a ask price. Okay. These days, cryptocurrencies market, if you see, they have evolved on a similar pattern. They are all code-driven markets. Okay, there will be a bid price and ask price to buy Bitcoin, Ethereum, or any other cryptocurrency as well on any platform that you are trading. Okay, so you will see a bid price and a ask price. So these are called as code-driven. Okay, so any questions to this point? No, all clear.
What is the minimum required of listed in large?
There is no minimum required. 100 biggest stocks by market capitalization are called large caps. Okay, so the distinction is made like this: 100 biggest stocks today by market capitalization. That reminds me, we had also talked about share capital and market capitalization. Can somebody tell me, if somebody asks you what is market capitalization, what will you tell them?
Value.
Market capitalization is the value of the company today. How do you calculate it?
Present value multiplied by
The current market price. Okay, how do you get the current market price? You can Google whatever number of shares, whatever shares. Okay, you can Google for the current market price, and you can also Google for current total number of shares of a company. Multiply them. If a company has 10 crore shares, okay, example, if a company has 10 crore shares, and if the price per share is 150, when today, okay, please understand, today market capitalization can change daily. It can change multiple times in a day also, because price keeps going up and down. Okay, so normally when people speak of market capitalization, they speak of the day end price, because in the day the market will keep going up and down. Okay, so if the price of a stock is 150 and the company has 10 crore such outstanding stocks, what is the market capitalization of this company? 1500 crores, 150 rupees share price, 150 outstanding shares, 10 CR. So if you multiply this, market cap comes to 1500 crores.
1500 crores.
Right? So this will probably be called a small cap. Why will this be called small cap? Because large cap basically means companies who are top 100 companies by market capitalization. So top 100 companies by market capitalization are called as large cap. Now, so is there a fixed number that above this is large cap? No, that number keeps going up and up all the time, right? Because our companies are going higher and higher in market capitalization, which means if some company becomes the top 100, somebody will be replaced. Okay, so this is not a permanent list. Okay. What is mid cap? Company number 101 to company number 250 by market capitalization are called as mid caps. And what is small caps? Everything after this is a small cap. Okay, many a times you'll find people saying the market has gone up or the market has gone down. What are they referring to? What actually has gone up? The index has gone up. Which are the two indexes which we track most often in India? Sensex and Nifty. Okay, Sensex is made up of how many stocks? 30 stocks. And Nifty is made up of 50. Okay, so which 30 stocks? The largest 30 stocks, which means they're all large cap, but not stocks make sense. Okay, same for Nifty. Okay, 100 largest cap stocks on NSE. So all large, the Nifty stocks are all large cap, but there are 50 which are not a part of Nifty in spite of being large cap. So Nifty is made up of 50 stocks. So only 50 out of 100 large cap stocks form a part of Nifty. So we have had an overview of the capital markets and we have had an overview of the money markets. Okay. Now let's have a brief overview of the derivatives. So what is the derivative? Yeah, futures is a type of derivative, true. But derivative market is a little different from all other markets in the respect that derivatives is not something which is bought and it's not a product. Like if somebody asks you what is equity, you can tell them that equity is a percentage ownership of a company. It gives you a right to a company. It's a product that tells you that you are a shareholder of the company. What is debt? Debt is a form of loan. Okay. What is money market? Money market is a form of short-term loan. Okay. So derivative is not a product. What is it? It's a contract. It's a contract. And this contract can be based on any other product. It can be based on equity, it can be based on debt, it can be based on gold, it can be based on commodities, anything. Okay. Once again, derivatives is a topic where we will have an entire week dedicated to it, not just one class. Okay. We'll study basics of derivatives, we'll go to futures and options. We'll have one class probably for options, and then there's another derivative type which is called swaps, where we'll have maybe 2 or 3 classes dedicated. Okay, so we will get into more details of this, but today we'll have a little bit of an overview of this. Okay. So what is derivative? What did we understand? Derivative is it's a contract. Now let's understand this with a simple example. Let us say there is a village where there is a farmer. Okay. So this farmer grows wheat. Okay, there's a farmer who grows wheat. Now I have no clues what the wheat prices are in the market, but I'm just going to put some numbers here. Okay. So farmer goes to the market because his wheat is ready. He wants to sell his wheat in the market. Okay. And the farmer finds that the wheat is selling for 100 rupees. The farmer is happy selling the wheat for 100 rupees in the market. Okay. At the same time, in the market, there is also a owner of a flour mill who also has come to the market. What is a flour mill? Atta chakki. Okay, who also has come to the market. What is the reason why this fellow come to the market? This fellow has clearly come to buy wheat, right? Okay. So this flour mill owner also comes to the market to buy wheat, and he buys wheat at 100 rupees. Now, once again, I'm treating this as an example. Obviously, buying price and selling price cannot be same in any market. Otherwise, the people in the market will not make any money. Okay, but for the purpose of example, just consider this. Okay, so the farmer grows wheat, goes to the market, finds out that the market price of the wheat is 100 rupees. Okay, and sells the wheat at 100 rupees. The farmer is reasonably satisfied. Why? Because the cost of raising the wheat was 80. The cost of raising the wheat was 80. So the farmer thinks that, okay, fine, this time it has been a good deal. Okay, I am making 20 rupees of profit. I just hope that the prices remain about 100. I just hope that the prices remain about 100 rupees. The flour mill also goes to the market, and the flour mill is fine with 100 rupees. Okay, is fine with 100 rupees. The flour mill starts thinking the price is 100 now. But if the price starts going up from here, then I will have a difficulty. I have already increased atta prices last month. I cannot make another increase in atta prices next month. And if I make so many increases, my customers will start going to other places. Okay, so that is the thinking of this flour mill owner. The flour mill owner thinks, fine, this time I got it for 100 rupees, but if the price increases any more from here, okay, it will be difficult for me. So I would like the price at 100. Okay. Let's just say that if the price maybe goes to 120, then the flour mill owner is left with zero profits. Okay. So this farmer and flour mill owner happen to chat in the market. And the farmer starts to say, prices are 100 rupees, it's a good thing. But if prices starts going down, okay, I will not be able to get enough money for my living. Okay. The flour mill owner also says that, okay, prices are 100 rupees, prices at 100 are fine, but if the prices start going up, I will not be able to make enough money. So they both come up with a simple solution. What solution do they come up with? They come up with a simple solution that next time the farmer will sell directly to the flour mill. At what price? At 100 rupees, irrespective of whatever the market price is. Okay, irrespective of whatever the market price is. So they now have nothing to do with the market price. Let the market behave the way it behaves. Sometimes it goes up, sometimes it goes down. It keeps changing all the time. I don't care about it anymore. Why do I not care? Because the farmer has got a guaranteed buyer at 100, and the flour mill has got a guaranteed supplier at 100. Okay. The contract that this farmer and this mill owner made is called as, what is the name for this contract, anyone? Huh? It's called as forward contract. It's called as forward contract. So what this farmer and the floor owner did just now is called as forward contract. So if somebody was to ask you, what is a forward contract? What would you say? you would say that forward contract is a contract between two parties where one party agrees to sell something at a future date at a fixed price, and the other party agrees to buy that something at a future date at a fixed price. Again, the date and the price have to be both prefixed, right? If the farmer wants to sell on 1st of June and the flour mill wants to buy on October, then there is no way to have a contract. Okay. So the price at which they are willing to buy and sell in future and the time and date at which they are willing to buy and sell, these have to match, without which obviously they can't have this contract. Okay, now tell me, their date of contract comes. Let us say they made this contract 3 months down the line, okay, because they have to prefix a date, right? 3 months down the line, the farmer will sell, they will have to prefix a quantity also, right? Everything will have to be prefixed. What all will they have to prefix? Date, price, quantity, quality, all of this they will have to prefix. Okay. Because otherwise the contract makes no sense. I am here coming with 100 kgs of wheat. Mill owner is saying, "Arey, mujhe to sirf 20 kilo kharidna hai." Okay. Or the mill owner is saying, "Arey, your quality is not good enough." So all of this has to be decided right at the time of contract. Okay. So let us say they have all made their decisions. The farmer's quality is exactly the kind of quality the mill owner is looking for. Their quantity is also fine. The farmer wants to sell 1 ton. The mill owner also wants to buy 1 ton. They have both agreed on this bit. Okay. And they have both agreed on a date also. And now the date comes. Okay. So the farmer will sell 1 ton of wheat to the mill owner. Okay. Now there are 2 possibilities here. 3 possibilities actually, depending on the market price. Because market price will be something. Okay. What happens, let us say if the market price, if the market price on the date of expiry, when the contract gets end, we will call it the date of expiry. Okay, because that is the time you'll have to execute it. If the market price on the date of expiry of the contract is 90, what happened? Who benefited by this contract and who lost because of this contract?
Buyers,
Who benefited?
buyers,
Both benefited, farmer benefited or mill benefited? How did both benefit? Contract will take place on the same price, yes. They have signed an agreement. If one of them defaults, the other can take them to the court. How many say floor benefited? Okay, how did that happen? Huh? Where is he buying a 90? उसने contract sign किया था ना 100 में buy करने का. अगर contract नहीं sign किया होता तो you could have gone and bought for 90 in the market. Huh? How is no one benefiting? Think about the farmer. If the farmer would not have this piece of contract, he would go to the market and sell. If he would go to the market and sell, what? 90. But because of this contract, he's able to sell it how much? 100. So
100.
who's benefiting? Farmer. Okay. Why? Because this contract is allowing this farmer, is giving the farmer an option to sell at 100, even though the market price is 90. So who's benefiting? Farmer. Okay. What if the price is, if the market price is 110, then who benefits? How both? Please explain to me.
No, say Omer.
How is the floor mill owner benefiting?
They made a contract with 100 rupees. So
He has done the contract at 100. Without this contract, he would have to go to the market and buy for 110. So this contract is now able to fetch him at 100. Okay. So if the price goes down, obviously the seller benefited, because the seller, the farmer, is able to still sell at a higher
still
price.
at 100. Yes.
Okay. If the price increased in the market, then the buyer benefited, because obviously if the without the contract, the buyer will have to go to the market and buy at a higher price. Okay. Now, can you think of a way in which both benefit from this contract?
To make another contract again.
Then who benefited will come to know only on the expiry date, right? But is there a way in which both can benefit from the same one contract? If the market price is never changed, at the best we can say, okay, what happens if the market price is 100? Then who benefited? Can you say both benefited, or actually should we say nobody really benefited out of this? Which one will be right to say? Nobody benefited. Benefit क्या हुआ? Benefit तो कुछ नहीं हुआ ना? Market price is just the same, so nobody benefited out of it. Okay. Is there a situation where you can think that okay, both can benefit from this derivative contract? There are only three things that can happen with the price ever. The price can go down. In which situation? The farmer or the seller benefits. The price can go up. In which case, the buyer, or in this case, the mill owner benefits.
Mill owner.
Or the price can stay same, in which case no one benefits. Okay. The price of any object can only do these three things. There is no fourth thing that the price does. Either it can go down, go up, or remain same. Okay. So what we can conclude is that in a derivative trade, not only for forwards, but for all kinds of derivatives, okay, there will be no situation where both parties benefit at the same time. Yeah, you can always sign another contract and then wait for another expiry and then see who benefits there. Okay, but that's the another contract, and maybe the farmer benefits this time and the farmer benefits next time also. Who knows? Okay. So what we need to understand, this is a kind of contract where one will benefit and one will lose. So why are people signing this kind of contract? The whole point is to hedge the risk, to reduce the risk. Okay. Because while signing the contract, nobody knows where the market price will go. So as a buyer, if I think that I get guaranteed to buy at 100 and 100 is a decent price for me, I will get into this contract. I fully understand that if the price goes down, I will lose out. But my thinking is that I don't want to bet on the price. If I can get at a reasonable price, 100 is that reasonable price. I am happy to pay 100. Okay. In trying to get at a cheaper price, I will also face the risk of having to buy at a higher price. Okay. So that is the hedge. Okay. That is the hedge. What does the word hedge means? Reducing the risk. Right. So what is the purpose of this forward contract? It is used to reduce risk for both the parties. And the same thought is with the farmer also. The farmer also benefits actually by the same way. So think about it. The real benefit of this contract is a peaceful sleep in the night for both of them. Okay, for the farmer also, that I will get reasonable profit, if not super profits. Okay, in the anticipation of super profits, I also have to expose myself to less profit or maybe even no profit. Okay, so farmer has cut out that. Farmer says, forget the super profit, reasonable, guaranteed reasonable profit is better than unexpected windfall. And that is exactly what the floor owner is also thinking, that a reasonable buying price, guaranteed reasonable buying price is better than unexpected fall in market price. Okay, so they can now both sleep peacefully, considering that they will be able to sell and buy at a particular price. Okay, so why do people get into this contract? Because of risk management. Okay, can you give me some other examples of people who might get into such contracts?
I had this I had the contact with him that I'll get that 33 rupees. I'll sell it for 70. So I had it for a long time.
Mhm.
So it's a community, right? Community market.
Fantastic. So you get water at 33.
And I sell it for 70.
Okay, so you have a standing forward contract which allows you to buy the water at 33 irrespective of the market price of water. Okay. Other examples. Right now, a commodity in lot of news is crude. Right? What if a petroleum refinery had already existing forward contracts which allows them to buy at, let us say, 98, 99? They will still be able to buy at those rates, even though the market prices of crude are shooting up. Okay, so oil companies and refineries could have these kind of forward contracts. Okay,
Yes.
mines and metal companies could have these kind of contracts. Okay, for that matter, anybody who buys and anybody who sells those things, they could have these kind of contracts. Impact of market price on either of them. Okay, so what do we call these kind of contracts? Forward contracts.
Forward contracts.
Okay, perfect. So forward contracts, are they exchange or are they OTC or are they OTC contracts? They are OTC because there is no exchange involvement here. Two parties do contract with each other. Okay, the two parties, the farmer and the mill owner, did not have any exchange which helped them do the contract. Okay, they did the contract with each other. So forward contract is OTC. Then there is something called as futures contract. futures is actually not another kind of derivative. It is conceptually it is same. Okay. What is different is that you yourself don't have to decide date, price, quantity. It is already decided by somebody else. You just have to come and make your trades for that date, that price, that quantity. Now, who is that somebody else? That somebody else is the exchange. Okay. So literally the only difference between a forward contract and futures contract is that forward contract is over the counter and futures contract is through an exchange. So it's exchange traded. Okay, so because it is exchange traded, all the parameters of the trade are already preset. Expiry will happen on a certain date. Okay, exchange has a lot size concept, so you can only trade in lots. Okay, you can buy 1 lot, 2 lot, 3 lots. So the quantity is also predetermined. So all of these things which two people who are going to trade will have to determine, date, quantity, etc., are all predetermined. And the price is whatever it is currently trading in the market. So you just look at the price. If you like the price, you trade. Everything else is pre-decided. Okay. So to that extent, getting into futures is far more easier than getting into forward. Okay. Because you can easily find what is it that exchange is offering you. And if you like that, you can get into the contract without much fuss. Okay. So as far as now is concerned, that is all about futures. Once again, as I told you, we'll have an entire class on forwards and futures. Okay. So next we'll just get a brief overview of options. Options is a different kind of derivative. So what kind of derivative is an option? Here is the basic way to understand this. In case of a future or a forward, one party makes a promise to buy, another party makes a promise to sell. Both parties are making promises, and both parties need to keep up with their promises. What happens if one of the party does not keep up with the promises? They will break the contract, for which they will be legally held accountable, right? Because you signed a contract. Obviously, if somebody has just orally agreed to terms and conditions, this will not really apply. Okay, but if it's a high value contract, obviously you would have signed. Okay, Okay, if it's just a regular of the mill, maybe you just did an oral contract and forgot it, in which case the breaker will face no legal consequences. Okay, but if it's a high value contract between especially two corporates like a crude oil supplier and a refinery, or a mine and a metals company, okay, there would have been a written contract and the breaker of the contract will face legal music. Okay, so both sides who get into a contract make promises, and both sides are liable to fulfill their side of the promise. Okay, in an option, only one side makes a promise, the other side makes no promise. Okay, that is literally the word saying right out there, option. One side has an option. The contract will be executed or not executed depending on what this one side wants. So to that extent, it's a biased contract, right? Giving all the parts to the one side. So let's understand the concept of options with the same example. There are two kinds of options. There is a call option and there is a put option. Now, what is a call option? Call option is an option that gives you a right to buy. Okay. Now, here is an example on the same line. Okay. In our story, the flour mill was the buyer. So the flour mill goes to the farmer and tells the farmer, look, if I have to buy at 100 rupees, it is such a good thing. Okay. But if the price increases from 100 rupees, I have huge losses. Now listen to this carefully. What does the flour mill say to the farmer? The flour mill says to the farmer, will you promise that if I come to you and ask you to sell me at 100, will you do so? Okay. What is the flour mill asking? If I come to you and ask you to sell me at 100, will you promise to do so? So what the flour mill owner is wanting is, if the flour mill owner comes to the farmer and asks him to sell at 100, the farmer should sell him at 100. But what if the flour mill owner doesn't come to the farmer at all and doesn't ask him to sell? Then it's totally okay. Which means if the price goes to 110, if the flour mill owner goes to the market, the flour mill owner will have to buy at 110. So what will the flour mill owner do instead? The flour mill owner will go to the farmer and said, look, you promised sell me at 100. Right? The farmer will sell at 100, saying, yeah, I promised. Okay. But what if the price goes to 90? Now the flour mill owner won't go to the farmer only. Just go to the market and buy the market. So now, who is benefiting in both the cases? Flour mill owner. So was farmer way too much drunk to have signed such a contract? Why did farmer sign such a contract? What is the farmer getting? Okay, in the earlier case, we understood, like, if the price is 110, the farmer loses out. But if the price is 90, the farmer benefits. Nobody knows what the price will be in future. So there was an equalness in the contract, right? One of them will benefit, one of them will lose, but nobody really knows who will benefit, who will lose. Okay, both sides have a promise made, and both sides have to keep their promise to each other. That is a contract, we understand. I mean, who in their right mind signs this kind of contract? For what reason might a farmer sign this contract? Fine. If there is excessive supply, also, what am I getting out of this contract? What is the farmer getting out of this contract? If the farmer strongly believes the prices will rise, he can also sit without doing any contract, right? Why did you do this contract? You are going in the right direction. There is one more point here.
That you might sell the goods. The price rises.
I think the price will get.
If the price decreases, how will the farmer benefit? And chance of selling him goods, chance is always there in the market as long as you are willing to sell at the market price. Okay, and that is what the farmer will ultimately have to do. If the price goes down, he'll have to sell at the market price. And if the price rises, the farmer will not get that market price. Are you understanding this? Okay. If the price falls down, the mill owner will refuse to buy because the mill owner has made no promises. Can the farmer sue the mill owner and take him to court? No. Where did the mill owner made no such promise to buy? Are you with me? In this contract, the farmer cannot take mill owner to the court for not buying at 100. If the price is 90, 80, 70, the mill owner is in no way obliged to buy at 100 because the mill owner made no such promise. Okay. But if the price is 105, 110, 115, the farmer will lose out on those opportunities of selling in the market because the mill owner will ask to sell at 100 and the farmer has promised. Okay. So here is why the farmer might get into this contract. Are you clear about the picture right now? Does this contract look completely biased towards the mill owner, where farmer has nothing to gain and mill owner has nothing to lose? So let's add that one element. What is the element which the mill owner is going to lose and the farmer is going to gain? Okay. Now this contract comes at a premium. This contract comes at a premium. Okay. In order to get into such contracts, the mill owner will have to pay money to the farmer as premium. Okay. So let us say the mill owner asks the farmer, look, please promise me that you will sell to me at 100. Then what does the mill owner says? You will sell to me at 100. Okay, if I come to you and ask for it. Okay, if I come to you and ask for it. A farmer's thought is that the prices are actually going to go down. The prices are going to go down, which means the mill owner is not expected to come and ask. Okay. So the farmer will say, okay, do one thing, give me 5 rupees and I will give you this promise. What does the farmer do? Give me 5 rupees and I will give you this promise. Come to me and take for 100 rupees. And in order to make such a promise, give me rupees 5. 5 rupees is my charge. So what does the mill owner lose? 5 rupees. What does the farmer gain? 5 rupees. Okay. Now look at all these possible situations. If the market price is 90, okay, So to get into this contract, of letting the mill owner buy at 100 with no promise, the farmer charged a premium of rupees 5. Okay. Now, if the market price is 90, what will happen? Will the mill owner come to buy? No. The mill owner will buy from the market at what price? 90. But he had also paid 5 rupees of premium for the contract. So the mill owner's real cost will be 95. Farmer will also go into the market and sell at 90, but he had also got 5 rupees of premium from the mill owner. So the farmer's real sale value is 95. Okay. So in fact, if the farmer's prediction is right about the market price and the market goes down, this has been a decent contract for the farmer, because without the contract, all you would do is sell at 90 and make no additional money. Okay. But because of the contract, I have sold at 90 and got extra rupees 5 because the contract was never exercised by the other party. Are you with me? Right? What happens if the price is 100? So if the price goes down, the mill owner will not exercise the contract. Okay. And farmer will get to keep all the premium money as income. Okay. What if the price stays same? The mill owner may buy from the farmer or may buy from the market. Either ways, it's going to be the same thing. Okay. But still, what has been the mill owner's cost? 105. What has been farmer being able to get? 105. The farmer has been also able to get 105. 100 rupees by selling in the market and 5 rupees as premium from the mill owner. Okay, so farmer still benefited by rupees 5. Okay. So what happens if the price goes by 100 and if the market price is 103? Mill owner will buy from farmer, but who has profited from the contract? Think about it. No, not the mill owner. Mill owner has
Farmer.
how much? 100. But he had paid how much premium?
5
Mill owner's
rupees.
cost has been 105. Okay, the mill owner's cost has been 105. Okay, so has the mill owner benefited from this contract? The answer is no. Farmer still benefited by rupees 2. Okay, so we understand that the prices can do exactly 3 things. Prices can go down. If the price goes down, farmer benefits. Prices can stay same. If the prices stay same also, farmer benefits from this contract. Prices can go up, but if the prices go less than 5 rupees up, still the farmer benefits from this contract. It's only in the situation when the price goes by more than 5 rupees up, the mill owner benefits by this contract. So now suddenly this contract is looking like it is skewed towards the farmer to win all the way. Okay, so why did the mill owner sign this contract? It has done a completely opposite direction. Earlier, we were feeling that why did farmer sign this stupid contract? Mill owner gets all the rights here, farmer gets no rights. But now, if we analyze this contract into a little bit of more detail, we start thinking that chances of farmer profiting from this contract is clearly far higher, because prices go down, farmer profits, prices stay same, farmer profits, prices go up also, but only slightly up, farmer profits. Only if the prices go more than 5 rupees up, the mill owner profits. So why did the mill owner get into this contract? In which it seems like most of the time the farmer will only profit.
Irrespective of market, it is maximum 105 only.
Irrespective of the market, he will pay maximum of 105. And if the price go down, he will be able to take benefit of those lower prices. Okay. So basically he's saying that if the price goes down, I should be able to take benefit of those down prices. Okay. If the price goes to 80, I'm happy paying 5 rupees. I'll be able to buy 85. If I were to sign a contract promising to buy 100, then I'll have to honor that promise. Okay. I will not be able to benefit from lower prices. Okay. And if the price gets higher, I am covered. I have a farmer who is willing to sell me at 100. Okay. So basically, what the mill owner thinks is 5 rupees is a reasonable amount of money to lose for such a deal. Okay. 5 rupees is a reasonable amount of money to lose for such a deal, because if the price goes lower, I will not miss out on my profits of being able to buy at a lower price. And if price does not go low or goes high, my buying price is fixed at 100. Okay. So what does the mill owner think? I might as well lose 5 rupees and get into a contract like this. Okay. So that is what the mill owner is thinking. And that is why people get into options contract. Okay. So let's do a quick recap of option. Re-understand what options call option is, and then we'll take a break. Okay. So call option gives you right to do what? Buy. Okay. So somebody wants to buy and they are trying to get a right to buy. Okay. Does the buyer make any promises to the seller? No. Our buyer, the mill owner, made no promises at all to the seller. Okay. The buyer made no promises. It's only the seller who was making promises. What promises did the seller make? Seller has a predetermined price, 100 rupees. Seller says, I will sell you at this price. I promise to sell at this price. Understand? The buyer has the buyer made any such commitment that I will buy at this price? No. So if the buyer refuses to buy at that price, can the seller take the buyer to the court? No. There was no promise made to buy. Where is the question of taking you to the court then? Okay. So the buyer made the buyer made no such promise that I will buy for 100. It is only the seller who has made a promise that they will sell for 100. Okay. So why did they make this weird kind of promise where there only one side is making promise? For a amount of money which we will call as premium. Okay. What is the benefit to the seller? Most of the time they will benefit. Why? Because there are exactly 3 things that the price can do, and 2.5 times the buyer wins, the seller wins, right? The price goes down, the seller wins. The price stays same, the seller earns premium. Okay, the price goes up, but not enough. The seller still gets to keep at least some bit of premium. Okay. It is only when the price goes up by the 100 rupee plus the premium charged, the seller will lose out. So most of the time, farmer will benefit from this contract. So now if most of the time farmer is going to benefit from this contract, why is the mill owner signing this contract? Mill owner thinks of 5 rupees as a reasonable price that he is willing to pay to make sure that the supply at 100 is guaranteed, but if the price falls, he'll be able to take benefit of that price fall. Okay. So maximum that the mill owner can lose is 5 rupees. There is no way the mill owner can lose more than this, because if the price goes to 90, he'll go and buy in the market at 90. Right? Clear? So options, are they traded on exchange or are they OTC? They are both. Options contracts are traded on exchange as well as there are OTC options. Okay. So futures and forwards are also done both, but they just have different names. If it is done over the counter between two people, we just call it forward contracts. And if it is traded through exchange, we call it futures contracts. So forwards and futures essentially fundamentally are the similar kind of contract, except that OTC version is called as forward, exchange traded version is called as futures. In options, we don't have different names. It can be traded on exchange or it can be done OTC between two people. Either ways, it's called options. Right? So which is the option? The example of which we took just now, call option. It's an option that gives a right to buy. Okay. So at this point, we will take a break. Okay. It is 10:42. We will restart at 11.
Sir, your voice is not listening here. Sir, we are not able to listen your voice.
Okay, everyone, can you hear me now? Everyone online, can you hear me now?
Yes, sir. Yes, sir.
Okay, thank you. So here is a question. Give me a name of any commodity. Crude oil, ठीक है. Fine. What will be your profit and loss if on expiry the price is 90, the price is 100, the price is 105, the price is 115, the price is 130 and 150. In each of these cases, what will be the profit and loss?
So what have you done? You have a call option, which means you have bought, which means do you have the right or have you given away the right? You have the right. You paid premium for that right? Okay. So obviously, you know that price can be whatever it can be. So what would be the profit or loss in each of these? I'll add one more here, 70. Do we have the answers? Okay, so at 70, what will be your profit and loss? How will you have profit at 20?
There will be loss of rupees 10, sir.
Okay, what will it be?
Rupees 10 loss.
Okay, so we have one answer in loss. Santosh?
In
What is
first
10
three,
loss?
sir, in first three there will be loss of rupees 10, sir.
Okay, how many say loss of rupees 30? How many say loss of rupees 20? How many say loss of rupees 10? Okay, explain why loss of rupees 10. What he has done is he has given away rupees 10.
He has already given the 10 rupees.
Given away rupees 10. Has he got into a deal because of that rupees 10? No. So can we say that 10 rupees is wasted? Can we say that 10 rupees is wasted? Yes, why not? It is wasted, no? He paid 10 rupees for a right to get, or rather he paid $10 for a right so that he could buy crude at 100. Okay, has he been able to use that right? No. So can we say that this right has not been used and hence wasted? Waste of $10? Now, if he would have got into a forward contract, he would have lost $30 here. But in case of an options contract, he has only lost $10. Okay. So if this was because this is a call option, his loss has been how much? 10 rupees. If this was a forward or a futures, his loss would have been 30. What about if the price is 90? Loss of 10. Obviously, the deal will not be exercised. Maximum loss is 10. Over here, the loss would have been 10 as well, right? Because you have promised to buy at 100, market price is 90. So the loss has been 10. Over here, loss of 10. Over here, and in forwards, it would have been loss of. In forwards, it would have been loss of. No profit, no loss. This is where this breaks even. At 105, what do we have?
Loss of rupees 5.
And if we have this 110 over here, that will be a break-even point for this. So here we have profit of 5. At 110, we have no profit, no loss. Over here,
10
we have
10 rupees profit.
10 rupees profit. And for here on, profit will increase. Okay. So here you will have 5, here you will have 15. Here you will have 20, and here you will have 30. And here you will have 40, and here you will have 50. Okay. So the whole point of an options contract is to put a maximum number on your loss. Okay. Whatever the market price does, even if the market price goes to 50 now, your maximum loss will not exceed rupees 10, right? And that is clearly the reason why people get into a options contract, right? Okay. So why do people get into an options contract? Because so that they do not lose any more than the premium they pay. Okay. If they gain, their losses will only be limited. For example, if the price goes to 150, okay, they might not think too badly. अरे futures होता तो या forward होता तो मैंने $50 बनाया होता, मैंने $40 बनाया. That is okay. Okay, that is a reduction in risk that they are getting, that by of a guarantee of not losing more than rupees 10. So that option is called as which option? Call option. So I told you there are two options. One is a call option and the other one is a put option. What does a put option do? Opposite of call option. Call option gives you a right to buy. So what must the put option do? A right to sell. So the put option gives you a right to sell. Call option gives you a right to buy, and put option gives you a right to sell. Okay. At the moment, we are not going to get into the details of put option, but for all practical purposes, it is exactly opposite. Okay. So we have covered three kinds of derivatives. First derivative which we covered was forward. Okay. So forward contract is a kind of derivative which is not really a new kind of derivative. It's a simple trade between two people. One person has agreed to buy, other person has agreed to sell at some future date at a fixed price. Okay. Contracts like this are nothing new. Contracts like this have probably been happening for centuries altogether. Okay, since the ancient times. The other derivatives are have taken birthplace with the modern finance. Like for example, futures cannot exist unless an exchange exists. Okay, options has been a more or less recent phenomenon. Okay, so difference between futures and forwards, are they two different kinds of derivatives? Or are they same kind of derivatives, but just where they are traded is different? So a futures is traded where?
Exchange.
Exchange. And then forwards is traded where? OTC.
OTC.
Where does it get traded? Both. Okay. It can be exchange traded as well as it can be OTC. Okay. Now I'll also brief you about the last type of derivative. Okay. Actually, not the last type of derivative, but the four major derivatives. Okay, that we have in our syllabus. Okay, so what is the fourth major derivative that we have in our syllabus? We did forwards, we did futures,
Future.
and the next one is swaps. So is swap a OTC derivative or exchange traded derivative? Are swaps traded on any exchange? The answer to that question is no. There is no exchange in the world where swaps get traded. Okay, but there is a huge market for swaps. The market for swaps is really big. Okay, and most of these market is catered to by swap banks. Who is a swap bank? An investment bank works like a swap bank, just like an investment bank works as a lead manager. Okay, so swaps present a good business opportunity for investment banks because people need help to get into swaps and there are no exchanges where swaps can be traded. Okay, so what exactly do you mean by swap? The word option means having a choice, right? So in the option derivative, call option gives me a choice whether I will buy or not. Having a put option gives me a choice whether I will sell or not. Okay, so the word option just means choice, and that is exactly what it gives. The word forward or futures tells us that there is something to do with coming time, coming future, and that is exactly what it does. Okay. And the word swap tells us what? Exchange. Okay. So that is exactly what we are trying to do here. The question comes, exchange of what? The most common swap, there are several things that can be swapped, but the most common swap is called as the interest rate swap, or the loan swap. Okay. Now, what do we mean by this? What we essentially mean by this is, okay, I have a 100 crore loan, you also have a 100 crore loan. So one fine day we get together, and then what we decide is, I have a 100 crore loan and you have a 100 crore loan. Okay, I, instead of paying my own loan, will pay your loan, and you, instead of paying your own loan, will pay my loan. Right? Now, why did we get into a deal like this? Because we had nothing better to do that day, or there must be a reason. What could that reason be? Hmm? Could be. What kind of condition? Okay, tell me, if your interest rate is at 9% and my interest rate is 12%, would you agree to switch with me? If my loan is 100 crores and your loan is 50 crores, will you agree to switch with me? Again, no. Okay. Interest rate, period, they are all the right answers. But how it happens is a little different. There are two kinds of loan. One is at fixed rate and another is at floating rate. What do you mean by floating rate loan? Floating rate loan means amount of loan. The interest can go up and can go down, right? The amount of interest can go up and down all the time. In which kind of loan? In a floating rate loan. Okay. So in a floating rate loan, the amount of interest can go up and down. In a fixed rate loan, will the amount of interest go up down? The answer is no. In a fixed rate loan, the amount of interest will not go up down. So one of them has a fixed rate loan and other of them probably has a floating rate loan. Okay. Party A has a 100 crore loan at fixed rate of 10%. Party B also has a 100 crore loan at a floating rate of 6%. Now, what is MIBOR? MIBOR stands for Mumbai Interbank Offer Rate. Mumbai Interbank Offer Rate. Now, the thing about this is B is that their rates can change. Their rates can change. Their rates will not be fixed at MIBOR plus 6%. Okay. Whatever MIBOR is over and above 6% of that. Okay. Or let me just change it a little, MIBOR plus 4%. Okay. So what is the rate? MIBOR plus 4%. Whatever MIBOR is over and above 4%. Now let's assume that MIBOR happens to be 5%. So this year, what will be B's rate? What will be B's rate? MIBOR is how much? 5%. That is what we have assumed. Over and above MIBOR, how much are we paying? 4%. So total 5 plus 4. So B will pay 9% and A will pay 10%. So A will pay 10% and B will pay 9%. Okay. So now A thinks B का कितना फायदा हो रहा है? B has to pay 1% less. What does B think? B thinks इस साल 1% बच गया, but किसको पता है अब ये रेट कब ऊपर जाएगा, कब नीचे जाएगा. Okay, especially it looks like that in coming years the rate will go up. So both have opposite views about what is best. A starts feeling that my fixed rate loan is a bad thing. I would have rather taken floating rate loan, तो मेरे पैसे बच जाते, I would pay less interest. Okay. B start thinking that floating rate loan is such a horrible idea. Rates of interest are going to go up, and if rates of interest go up, I will have to pay so much more EMI. Right? So what do? A and B get into a contract whereby A agrees to pay B's loan and B agrees to pay A's loan. And that is the reason they will swap. Right? Is this clear? Okay. Now within swaps, there are different types of swaps. All of that you will learn in 2 or 3 days. They're exclusively dedicated to swaps. Okay. So for now, this is what we wanted to achieve about derivatives for you to have an overview of everything that we will obviously later on go into detail. Okay. So once again, let us recap of everything that we have done in last 2 days. Okay. All the overviews that we have taken up in last 2 days. In the last 2 days, what have we learned? We have learned about different market products. 3 different markets we have looked at: capital market, money market, and derivatives market. What products are part of capital market? Debt and equity. Primary market is new issues and secondary. Okay. So when a debt or equity product is first launched, what market do we call that? Primary market. And when it is traded, the existing equity and debt are traded, we call it secondary market. Okay. The objective of capital market is to raise money for short term or raise money for long term. Long term. Does equity have any maturity time? No. Equity has no fixed maturity time. It will go on forever. It is perpetual in nature. Okay. Does debt have any maturity time? Mostly yes. Why did I say mostly yes? Because there is something called as a perpetual bond, which you will study once you are studying bonds in detail. Okay, so but most of the debt does have a fixed time period. Okay, equity on the other hand has no maturity. So basically anybody raising the equity makes no promises of returning the money and makes no promises of any guaranteed returns, thereby reducing their risk. Anybody raising capital as debt makes a promise to pay fixed return as interest and also return the money, thereby increasing their risk. Okay. From an investor's point of view, debt gives you a promise to pay back the money, and debt also gives you a promise to pay the interest. So your risk gets reduced. Equity makes no such promise. So as an investor, equity is risky. Okay. Fundamental rule of all financial world. A person will take a higher amount of risk only and only if there is expected higher return that can be achieved. That expected word is important here. Okay, there has to be an expectation of a higher amount of return. Okay, if higher return cannot be expected, then it would not be a good idea to take higher risk. Okay, so money market, what is the objective of the money market? To raise funds for short term. This short term is generally defined as how much time? Less than 1 year, up to 1 year. Okay, so there are different money market instruments through which banks raise money, through which corporates raise money, through which even governments raise money. Okay, and all of them have a time period of up to 1 year or less than 1 year. Okay, then we talked of debt through bank and debt through issues. Okay, now if I have put money, deposited money in bank, which means if I've given a loan to the bank, can I sell off that loan? Can I sell off my FDs or my current account or savings account? No.
No.
So there is no market where you can sell off your bank debt, but can you sell off your debentures or government securities?
Yes.
How can you sell them off? You can sell them off through an exchange if they are traded, or you can sell them PC as well. Okay, either ways you can sell them off. Okay, now that is as far as our debt and equity is there. In money markets, do there is equity? No. Why not? Because it's a short-term loan. It's a short-term funding need. There is no
Sure.
need to raise a perpetual capital for a short-term funding need. Okay. Many a times you'll be asked, in debt market also you raise debt, in money market also you raise debt. So why these two different markets? Debt market you say is a part of capital market. In money market also you raise debt only, no? That is short term. The difference is not in the kind of nature of the instrument. The nature of the instrument is same. You take money, you give back the money with interest. That is the nature of the instrument. That is the nature of the instrument for debt also, and that is the nature of the instrument in money market also. But debt in capital market is raised for long term. In money market, it is raised for short term. Okay, we spoke of order driven markets and code driven markets. If somebody says, what is the one big advantage of code driven market, what will that be? Flexible price may not be the right answer. How will there be flexible price in the code driven market? Because let's go to a jeweler. Jeweler will say, this is my buying price. You have to select that price. Profits you can make in either of the markets. Obviously, people won't trade in the market if they can't make profits. And losses also you can make in either of the markets. Brokerage is not there in the code driven market. From a seller's perspective, think about it. In a code driven market, once again, in an order driven market, if I am an intermediary, what will my role be? To match buyers and sellers. If there is a buyer and if there is no seller, what will happen? Will his order get transacted? Let us say this person is flexible about the price. He just wants to buy. ज़्यादा में तो ज़्यादा में खरीदूंगा, कम में तो कम में खरीदूंगा, right? Because then you might say Reliance share, I want to buy at 2000 का तो rate ही नहीं है. But if a person says all I want is to buy Reliance share, give me Reliance share, price I don't care. Okay, but if there are no sellers of Reliance share that day, will he be able to buy? Opposite is also true. There is a seller of Reliance shares. Now, once again, Reliance is actually not a right example. There will always be millions and millions of shares traded of Reliance on any given day. Okay, but there are about 5,000 companies traded in the market. Okay, and the smallest 3,000-4,000 ones are not traded on a daily basis. Okay, and some of them may be only traded few times a year. Okay, so this example can be true for all those companies. Okay, so if I want to sell my Reliance share and I am fine with the price, I am just saying that okay, मेरा share कोई तो ले लो और मुझे पैसे दे दो. Will I be able to sell my shares if there are not even a single buyer? No. Now, why? Because the intermediary, the broker can only say that, okay, I am not going to buy your shares. I am not going to supply you shares. Okay. What I'm going to do is match up you with somebody else who's going to buy or sell. But in a quote driven market, if you want to sell, I will buy. Later on at what price I sell is my headache, not yours. Okay. So in a quote driven market, there will not be a time when a seller will have to return empty handed as long as the seller is flexible about price. Okay. So I will offer a bid price. And if the seller says, I am okay to sell at bid price, okay, the transaction will be done. The seller will be able to sell to the person, right? As long as you are comfortable with the jeweler's price, your sale, you will not have to come out of the gold shop empty handed. You can sell the gold, get money. As long as you are comfortable with the bid price of the bank that they are putting on your dollars, you can give them the dollars and come back with rupees. Okay. If you don't like that price, it's a separate, right? But if you want, if you are in need to sell today itself, okay, because the jeweler or the bank does not need to wait for the third party or a customer to arrive, the deal will be definitely done. So what you can say, quote driven markets offer liquidity, right? Because there is no need for the third party to come and bid. So what do quote driven markets do? Quote driven markets provide liquidity. Order driven markets, they provide what? In quote driven market, I do not understand behind the scenes work. Who is putting at what value? What is the price expected to move? I don't get all that data. So order driven market provides me a transparency. Okay, so we have quote driven market and we have a order driven market. In the financial system, example of a quote driven market, what will that be? Currency market is an example of a quote driven market. Indian stock markets is an example of a order driven market. Okay, if somebody says that commercial banks cater to retail clients and investment banks Okay, so what was I saying? The services that commercial banks offer are required by retail customers and are required by corporate customers and are required by somebody who's just getting a pocket money and are also required by billionaires. Okay, there is nobody who doesn't require a service of a commercial bank, and investment banks don't offer those services. Okay, their services are completely different. Okay. The services that they offer are not required by retail customers generally. Okay, or rather, let's say individuals don't require that services. Okay, unless somebody has lots of money, they might require, because they might decide to acquire a company, might merge with a company or somebody, even as an individual. Okay, but otherwise, generally, individuals or retail customers at least will not require investment banking services. Okay. So what questions do you have from this intro bit?
Hello, sir.
Yes, tell me.
Sir, in future and options, there is one term short covering. What does that actually mean?
I think this will be best discussed because at the time when we are doing those particular classes.
Okay, sir.
As of now, we'll not be able to get into details of this. Okay,
Okay.
because before we go to short covering, there is a lot more that we'll have to understand.
Okay, sir.
Okay, I can also tell you what short is. Okay,
Okay.
I can explain to you what shorting is. Okay.
Okay.
Imagine there is, I am selling these bottles and I have only 5 of them in my shop. And a customer comes and asks me, can you sell me 500 bottles? What will I say? I have 2 options. Either I can say no, or I can say yes and tell him bottles aaj sham tak mil jaye. And then I will have to arrange for those bottles before the evening. Okay. I will have to arrange for these bottles before the evening. Okay. This concept is called as shorting in the market. Okay. Short selling means what? Short selling means selling something that you do not have at the moment. Selling something that you do not have at the moment. Now, how can you do that? Because at the moment you just have to sell. You don't have to give delivery right now. If this customer was adamant, नहीं मुझे तो अभी का अभी ही bottle दे दो, मैं अभी ही bottle 500 bottle लेके जाऊंगा, तो मैं ये trade नहीं कर सकता था. Okay? Why can I do this trade? Because मेरे सामने एक customer खड़ा है, वो मुझे बोल रहा है, I will buy 500 bottles for 20 rupees. और मुझे पता है मैं आज शाम के पहले 500 बॉटल अरेंज कर सकता हूं and it will cost me only 15 rupees per bottle. So I have made a profitable trade. The same concept can be applied to financial products also. I can sell a stock without having it. How can I do that? Because delivery जब देनी होगी उसके पहले I will arrange that, which means I will buy those. Okay, think about it. मुझे लग रहा है कि है ना रिलायंस का स्टॉक अभी 2400 है. Reliance stock is 2400 and I have a feeling that this will go down. Now if I have Reliance stock I can sell it, but if I don't have Reliance stock, can I do anything? Can I do anything? The answer is still yes. I will still sell Reliance stock. Okay, as long as I can buy back within the market hours. Right? So today morning I sell Reliance shares. As of now, nobody will ask me for delivery. Okay. If I buy back anytime through the day, nobody will ask me for delivery. Okay. Because delivery to market band hone ke baad hi hoga. Okay. Delivery will happen only after the market closes. Okay. Delivery does not take place through the market. Okay. So Reliance stock I have purchased, sold for 2400. If my view goes right, remember I don't have this, which means buying is a compulsion. Okay, buying is a compulsion. I cannot say मैंने तो बेच दिया, मेरे को खरीदना नहीं. अरे आपके पास होता, आप बेच देते तो आपको नहीं खरीदना पड़ता. Right? You have sold something which you do not have, so buying back is a compulsion. Right? Because you have promised to give 2400, Reliance shares 2400, so you need to have those shares. Right? Now the thing is that if the market price does fall, let us say to 2300, so you have promised to give Reliance shares at 2400. Now you can buy back Reliance share at 2300. Thereby you have made 100 rupees of profit. Are you with me here? Is this clear? This concept is called as short selling or short. Okay. Selling something with an expectation of buying back before you need to give delivery. Okay. Remember, is this a safe concept or a risky concept? It's a risky concept because remember, if the price goes up, you will definitely still have to buy back. आपने ऑलरेडी बेच के रखा हुआ है, अभी अभी नाउ मैंने तो प्रॉमिस कर दिया, मैंने सोचा था 15 रुपए में बॉटल में अरेंज कर दूंगा, लेकिन मुझे अरेंज करने के लिए 25 रुपए में, तो भी तो मुझे करना पड़ेगा ना. I have already promised the sale. Okay, so that is the risk that you are taking with short selling. Okay, so if I were to sell short, it then becomes necessary for me to buy back because I've promised delivery at a certain price. Right, so that is what we mean by short selling. Short covering, you can ask to the respective trainer who will be taking this topic at that point of time. Okay, we'll need to go into a little bit of more detail. Okay, all clear? Fine. So any questions, let me know. Okay, then I'll call Utkarsha. Yeah. Sorry? No, debt market. GSEC and debentures are for long term. US market is a hybrid market. Earlier it was a code driven market. US stock market we are talking about. Earlier it used to be a code driven market. Now they have mixed to a system where they provide transparency as well as liquidity. So we call it a hybrid market. Okay. So in a code driven market, you are able to see what orders everybody else is putting because it's an order matching system. Everybody puts their orders and those orders are visible to everyone. Okay, so those orders are visible to everyone. Okay, in a order driven market, those orders are visible to everyone. In code driven market, those visible orders are not visible to everyone. That's the difference. Online we have currently 6 students. Yeah, more or less. Go on. आपको यहाँ खड़ा होना पड़ेगा तो सुनाई देगा. और actually my phone is connected as such. You can use this in your hand like this. They can hear you. Everyone, can you hear Utkarsha?
Yes, sir.
Hello, please reply.
Yes, sir.
Okay.
So everyone had attended the session yesterday also, right? You have taken admission late? Okay. What is your name? Kuldeep. You had called yesterday? I think so. Huh? I think I have received your email. You have dropped in an email yesterday? No email. Okay, okay. How is the session going? Understanding? This is no. This is yes. Okay. Understanding everything, right? Any concerns so far? कल क्या पढ़ाया? क्या पढ़ाया उसमें? Okay. Sorry. Money market, capital market. Understood everything? Everyone is from core finance background? What background are you from? Paride. Okay. So he's Siddharth. He's an internal SIBOP trainer. So from next week, he'll be taking your sessions. Okay. Any concerns or any constraints regarding to the SIBOP course, curriculum के regarding कुछ भी रहेगा, आप लोगों को इनसे पहले connect करना है. And my name is Utkarsha, so I'm handling the training governance part. तो अगर आप लोगों को कुछ भी दिक्कत रहेगा in respect to your training, LMS या schedule, anything sort of like that, technical issues and all those, you have to reach out to me. I'm there in your WhatsApp group already, so you can save my number in case of anything. First, drop in an email always. तो आप लोगों को मेजर लोगों का ईमेल आया होगा मेरे एंड से, राइट? सो एवरी फ्राइडेज यू विल बी रिसीविंग एन ईमेल फ्रॉम माय एंड फॉर द नेक्स्ट वीक का ट्रेनिंग शेड्यूल. अगर कुछ भी रहेगा, एवरीवन हैज गॉट द एलएमएस एक्सेस? You have not received? No one has received?
No, ma'am.
Okay, I'll check it once. LMS day 1 से go through करना है. तो नेक्स्ट जो भी टॉपिक रहेगा आपका, मेक श्योर कि जितने पीपीटीज, स्लाइड, पीडीएफ जो भी है, प्री रिकॉर्डेड वीडियोस एक बार सिर्फ गो थ्रू करो. डू नॉट रेटोफाई इट, नॉट रिक्वायर्ड, बिकॉज सारी चीजें यहाँ पे सिखाई जाएगी, बट आप लोगों को एक बार गो थ्रू करना है. ओके, एनीथिंग व्हिच यू वांट टू ऐड अप?
Yeah, I think just make sure that everything, whatever is being taught over here, I would just like to comment that from the conceptual perspective, it will be important to gain an understanding. Okay, just going through all these concepts, because there are a lot many concepts, lot many chapters will be going forward. So make sure that you prepare a little bit of notes, and at the same time connect with practical examples of the industry. Okay, so keep a habit of reading few of the newspaper articles related to finance, because I think since you are not having a finance background, so it will actually help you like with the terminologies, how the things are working on a practical basis, and then later we can of course connect with all those theories and the discussions in the classroom. I think that should be fine.
Everything rest will be explained to you in the class itself. तो कुछ भी रहेगा, कुछ भी डाउट्स रहेंगी, आप लोगों को पहले कनेक्ट करना है हम लोगों से. ठीक है? ओके. थैंक यू.
Thank you so much.
Hi, sir. See you. Yes. Chalo there, people. Bye bye. So here on, Siddharth will be taking your classes, but I'll keep seeing you whenever you are here. Okay. Good. It was 2 good days. Keep in touch if you want at any point of time. I'll be around.
Thank you, sir.
Okay. Bye bye. Bye bye. Huh? No, actually, I don't have this time free from next week. I have another class here only, so you will see me here, but in not.